Thanks for joining our inaugural venture into building the Mergehive community. And for those that are listening, welcome to our very first session. As we get started today, we did want to briefly explain our vision for the Hive and a little bit about who we are and key topics for today. Many of you have probably found, there are a lot of those educational M&A podcasts and webinars, but not a lot of M&A people who really connect and have real talk on a variety of M&A topics. And so as those can be fun and it's educational is great, we really wanted to kind of take it to another level and make it a little bit more nitty gritty, have some real stories, just have some sort of points of views from different M&A practitioners. And obviously, keeping confidentiality at the forefront. Starting Mergehive, we wanted to change the narrative and really create more of that real talk. And it's something where we wanted to be able to kind of go to another level, whether it's a forum to share and hear stories from other M&A practitioners, or it's drilling into more detail on a specific issue, or potentially even just kind of doing that advanced topic discussion for seasoned M&A folks. There are certainly multiple areas that we wanted to kind of fill in those gaps and kind of expand upon what you already see out there. And certainly if you have something you want to share, we welcome that as well, and certainly welcome you into the community for us to also host and kind of get some more participants involved. Now, before we kind of jump into our first podcast, we did want to share a little bit about ourselves, who we are, what drives us to continue the M&A work and start this community. So I'll get this kicked off. I'm Vicky Fang, and I have been doing M&A deals for about the past 20 years. And I've done everything from the corporate strategy and development side to kind of the service provider side, from investment banking, financial, non-financial due diligence, as well as integration and separation management. And I've also seen mom and pop deals all the way up to the Fortune 100. And I've also seen multiple flavors of success and failures. So a lot of different experiences that I can certainly share and add value to conversations. I want to kick this over to Sarah Rodgers next, who is also my partner in crime in kind of building out Mergehive.
Great, thanks, Vicky. As Vicky said, Sarah Rodgers, very similar background. I have spent the better part of 20 plus years in the M&A space, ranging from large global financial institutions to very small mom and pop companies. One of the things that I love working with Vicky, we've been working together for a number of years, is that our skills are very complementary. She does a lot of the corporate strategy and the deal, but I tend to focus more on the operating model and the execution, along with playbooks and change management. Everything from full integrations to partial integrations, divestitures, transition services agreements, and things like that. That has been my focus. So working with Vicky is one of the joys as I've progressed in my career. So Vicky, nice to partner with you on this.
I know, it's always fun. It's always great to.
It's great. Over to you. You are our special guest today. Welcome as we get this officially kicked off from the Mergehive perspective. Pleasure to have you.
Thank you. So my name is Nitin Kumar. I'm one of the co-founders of MergeFlow. Like the two fantastic ladies here, I have also spent a better part of my 2 decades doing M&A, probably 1,000 deals, 800 odd diligences, commercial, operational, technical deals. Done a lot of M&A strategy, done a lot of integration, separation, same story, mom and pop to mega deals and everything in between. My claim to fame was I used to do a lot of strange deals, hostile takeovers, activists. I've done something called carve-ins and things like that. So everything is a new learning. Every time you think you've figured everything out in M&A, there's always something that comes and humbles you there. So the more you know, the less you know is the game.
Pretty much, yeah. There's always something new for us to learn, which is why I think, having these discussions is really great too, just to kind of share stories, especially Nitin, with all the 1,000+ deals that you've done. You certainly have a lot of insights. With that, for our inaugural session, really at the start of 2023, we wanted to kind of kick it off first at sort of a macro level, but really focused on the short trends in M&A. And kicking this off then, Nitin, I'm going to throw the first kind of question over to you and just kind of get the conversation going. But, again, as we saw coming out of 2022 and into 2023, we're still seeing a lot of big moves by large corporations, but not necessarily that positive trajectory M&A activity. We've definitely seen layoffs. There's definitely some hesitations with investments as well. But, what are you seeing? Kind of how is that playing out in sort of the world?
I think there's a few different tectonic shifts at play at the macro level, right? Number one is that the quantitative easing cycle is over. There was a lot of easy money that was pumped in, and that kind of jacked up the valuations. And the diametrically opposite effect is at play now. And what happens now with the quantitative tightening is the dollar goes up, right? So we have an asymmetry on the currency, especially on the US side. So as it is the emerging markets, quite a lot of them have been not going through good economic cycles. They've dollar denominated debt. And the 10-15% discount has now turned into like 25-30% discount, especially with the currency asymmetry power. The other thing is that people have really woken up to digital transformation is real. And Vicky, you and I have been talking about artificial intelligence and the proliferation with ChatGPT. I think people woke up to what we were seeing before. And in the era that easy money was there and the pandemic kind of coincided with it, a lot of companies saw easy growth. So if you look at a Netflix, DocuSign, Zoom, all these subscription-based companies, they had 3 years of growth front-loaded into 1 year. But end of the day, there's only as many subscribers. And as strange as this may sound, you sell digital transformation to the world sitting in Silicon Valley. But you made the cardinal of not doing digital transformation on yourself and hiring headcount. So obsession with headcount and the linearity that treated with the growth now comes up as the bills to pay for the party that we had. That said, I think it's spawning a large number of small deals. We had a large number of small deals with digital transformation and automation driven by ChatGPT and more of that coming into play. So what happens is the valuations have rationalized and the operational complexity out of acquiring has gone away. There are also lots of people who are now looking at, oh, maybe we need to do 1 or 2 divestitures to put some oxygen on our balance sheet, to also figure out, okay, some things were non-core, or we made a mistake, or this is more valuable somewhere else. So the operational complexity of acquiring the digital guys is like 20, 30, 40 people in terms of headcount and automation and all that. But that has now shifted to the divestiture side. Many organizations do not have divestiture capability. They do 1 in 3 years, maybe 1 in 2 years. Long story short, there are serial acquirers. There's nothing called a serial divestor. And the operational complexity of that is not the symmetric mirror image of what an integration is. So a lot of people are requiring help there, introspection there, kind of not wrecking the ship there. And many of them don't know how to justify it. They've already lost the revenue, and now you're taking the divestiture and putting it out. So the communication into Wall Street on why we've had an organic revenue dip and now another revenue dip by divesting an organization is getting interesting. So the number of conversations that I'm hearing from the network around that are also fairly interesting right now. Startups want to survive or they want to grow. So many of them are actually chasing the big companies to buy them at a lesser valuation, which is also an interesting shift. So there's a number of forces at play. Some are at conflict with each other, but we are in really interesting times with automation, digital transformation, macro headwinds, and some of the printing cycles in Japan and Asia are just about beginning. So it's a very interesting time for M&A. The jury is still not out whether we're going to see a large number of small deals or small number of very large deals.
You kind of, as you said, there's a lot of that conflicting stuff going on too, where, when you talk about AI and everyone's kind of chasing that, is that one where it's going to seem, or we're going to see more activity, not just in terms of trying to identify that next AI they can bring in, but also valuation? And or do you kind of see that, no, it's still, everyone's still kind of testing out the waters there, still trying to examine it as we kind of go into the year?
See, AI and digital transformation is sort of a very abused word in the industry, right? As we all know, it's almost like go back to the 90s and think about internet, right? So that's how people are using AI. Who does the internet belong to? It's just a way of doing things. It's in our operating model, and that's how AI is going to play out. So there's going to be different lenses and different use cases that is going to come alive with AI. It's not necessarily that, it's almost like, what's the use case of the internet? Why is everybody acquiring the internet? It almost feels like that era to me.
That's true. I'm still trying to figure it out.
And I think as companies are looking for areas to increase the revenue and to decrease operating costs, they're looking for ways to use the AI and to say, okay, how do we trim some cost? I think is what they're focusing on at this point.
Right, and if you, yeah, that's actually a very good point. So there's actually a spectrum of KPIs, right? If you think about where a technology makes impact, and obviously the valuation premiums are different. Taking out cost, increasing revenue through sort of automation, customer insights, and kind of cutting that down, leaning the assets, right? And optimizing the headcount. So if you take AI and kind of decompose into the 4 micro buckets of revenue, cost, headcount, and assets, I think then you play out on what is your priority as an organization and what premium are you willing to put on that.
Absolutely. And, having had a background in project management for several decades, that project prioritization, as you look at where you're going to get the biggest return on your capital dollars, is becoming more and more important because the capital is so much more expensive now.
Capital is expensive. And I think that also brings up another very interesting point, that the weightage on synergy from a deal has gone away, right? It's all about shareholder value, and they're starting to disconnect a little bit.
Right. Exactly. And depending on the industry and depending on the type of deal is where you go, okay, wait a minute, we've got to be a little bit more selective here. We want to grow very specifically in a very specific area instead of saying, okay, we want to have some sort of horizontal growth where we want to have a different variety in our product set. Now we're like, okay, wait a minute, our biggest money makers are X, Y, and Z. We have got to focus there. And that's what I'm seeing on the acquisition side as well.
Right.
Which now I'm going to shift a little too on that divestiture piece, kind of as you mentioned, and I know Sarah on your end too, with the network of people that you talk to often and kind of even on my end, and as you've already mentioned, that's popping up more and more. And it's also popping up where I feel like a lot of these companies also, they obviously don't know what they don't know, but they're not really understanding how to even get in front of it so that they can also, let's say, pretty up their house and be able to sell it at the right value. So kind of what are some things that you've been seeing, Sarah, and kind of the experiences that either you've had here in previous jobs, or just kind of what you're hearing from industry?
I think specifically probably the past 4 or 5 years as companies, and in my space, having worked with the smaller companies the past couple of years specifically, a lot of deals, lot of, okay, well, this is how we're going to do the integration, or we're not. And you say, okay, we're just going to figure out this integration as we go. We're going to take this in chunks because wait a minute, we want to do 2, 3, 4 year deals this year because this is how we really want to go in this hyper growth phase. That's great. And now all of a sudden things are starting to slow down, and the whole musical chairs thing. Okay, the chairs are starting to leave. You've got some integrations. You've got some companies that you've acquired. You're half integrated. You're sort of integrated. You're starting to see a shift in your margins on these products. And then we've got companies going, okay, well, wait a minute. Where are highest values? We've got to finish these integrations because we're sitting on excess operating cost usually. How do we get that out as soon as possible? And then really right size the business to adjust for those margins.
Yeah, so that is a very interesting point. I just came up with an example that I came in a previous life, right? So these margins are also some sort of a mirage at times, and people have an illusion. So there was this big business unit that's big Fortune 500 wanted to sort of hive off, actually Fortune 100. They kept saying this thing is like, oh, 9% margin, we need to get rid of it, it's not performing. We suddenly took all those corporate allocations away and standalone P&L. The margin goes from 9% to 26%, whoosh, and the parent company now starts looking bad, right? So there's a little bit of an illusion on how the allocations are done and how divestitures should be viewed and where the margin is calculated.
Absolutely. And then ultimately how the divestiture is done. What does that carve out look like? What's being carved out? Are we looking at assets, technology assets, intellectual property, agreements? What are we actually looking to divest, and how intertwined is that today? Are we just unwinding what we just integrated?
Yes, and half integrations are twice as difficult to disentangle.
Exactly. That's one of the bigger challenges I've been seeing probably the past 2 years, maybe, as companies have just started to go since COVID, once that kind of started to shift a little bit. Yeah.
Not a lot of fun at all, especially the execution of it too. The amount of time, the effort. And I think that's the other piece too, sometimes companies forget about is you can say you want to divest, but now there is also that people aspect of it, of how do you get, your folks engaged to make sure that the ones who do have to focus on divesting that piece out are doing it the right way, are incentivized to do it, and kind of what is going to happen to these folks as well. And then separately too, if you've got people starting to leave, how do you kind of finish through with this process? And then depending on how you have it structured, how's this going to look based on whoever's buying it? So certainly I think a lot of components where folks haven't quite considered the effort, the investment as well, not just in terms of getting it done, but just the people side of it really makes a huge difference.
Yeah, I you know me, one of my passion areas in M&A is it's all about the people. And that's super important to consider with the labor market still pretty strong. It's starting to soften a little bit, but that's been a bigger concern of how do we do right by the people in a divestiture situation. And sometimes they just went through an acquisition within a year or two. And that's tough. Change for people is hard. It's not supposed to be easy, but it's something, we do focus on, and sometimes it does get lost during the deal process.
But out of as we think about people too, this kind of just popped in my head in terms of, with the COVID, as you mentioned, COVID, and people working from home or hybrid sort of work environment. How have you seen that impact, whether it's the deal being done or whether it's that process of acquiring or divesting? Like, how has that kind of come through?
Oh boy, Nitin, you want to start with this one?
Yeah, to me, it's a little bit of a challenge in terms of, it depends on the industry, right? So if you're sitting in the Silicon Valley, tech media, telecom, or any of the new economy companies, you're generally used to going to the office and calling a Sarah or a Vicky, right? I mean, you're generally on email and all that. So the rhythm adaptation was not that difficult. It's like 50-60% of your time you work remotely. Even when you're in the office, you're kind of quasi-remote because you're a distributed team. The rhythm adaptation there was 100% of the time, 100% of the workforce is working remote, right? And we all know that the Zoom, Loom teams, these have been around for 100 years. It took a pandemic to change our behavior. Mm-hmm. So the impact on the new economy wasn't as profound unless you are accessing very confidential information or highly specialized equipment. But if you go back onto the manufacturing shop floor and, pharma companies who were scrambling, or people who were manufacturing chips, or retailers, right? It was a very difficult time, right? You just can't go to work because your work was in a mall or in a factory. So so the change was very difficult there, and almost to the point that businesses couldn't operate. So it's a very difficult factor to gauge in terms of whether there's a one universal way. I think for the easy and the more digital people, it went more digital, right? The people who were less digital, they just went the other way around.
Yeah. As you were saying that, it got me thinking as well of just the communication piece too. As I think with some companies that because of COVID went a little bit more remote, I think that they now have to be aware how much they have to focus on the right communication, because if you're doing a deal, sometimes people will kind of hear what's going on, or if the deal is announced, they still have other people they can talk to in the office about it. But if you're remote, it's just an email, or you just saw a news feed. So I think sometimes in my head, I feel there's got to be a good structure in terms of how you want to roll it out after an announcement. How do you kind of get it to everybody so that it doesn't feel so disconnected since you're not really in the office?
Yeah, I think two specific areas that would have been very, very hit hard are if you're a practitioner or a corporate executive going into those management presentations, you see the body language. That becomes a little bit difficult. And then if you look at the young people who are in, right, if you are in sales or wherever, you observe a lot by going into the field with people, right? How people talk, how people engage with the customer. So that part get lost. The other area, I think the operational areas are generally okay, right? With automation
Yeah.
and technology and all that. The other area is employee onboarding. If the employee is onboarded for X gestation period, depending on the culture of the company, and they're in some sort of a rhythm, I think it was okay because it was a new rhythm for everybody. But if you're onboarding somebody in between the pandemic, and if your managers and directors and executives have never done it, face it, nobody's been through the pandemic, right? So it is new to everybody. So so the way I say this is there's no one way to do it or get it right, but there are 99 ways to get it wrong.
Yep.
Yeah, I agree. I think just throwing a little bit of a different color here. I started in my first acquisition was 1999, right before Y2K, the whole Y2K. And very early in my career, I did a lot of traveling for work. And the biggest impact that I found was, especially in the first few weeks, the first few months of a deal, to be on site with whoever you've acquired, or if you're working with, I've done a couple mergers, being in the office and working with the people. And as you said, that body language and being able to read that, insanely important. And that for me has made all the difference of me being on site and spending the time, because you can sit and have a cup of coffee with the CEO of the company that you just acquired. And I'm sitting there going, I just got brought in, especially as a consultant, I would get brought in and be just given hey, here's the business case. This is why we're doing this. Just go make it work. And I'm like, great. So how are we actually going to do this now? And really being able to sit there and have the dialogue and sit with them and say, talk to me about your company. Talk to me about the culture. Where, I'm not asking you to disclose anything you shouldn't disclose, but where am I going to have challenges? Where do I need to focus? Where do I need to be sensitive? How is your head of sales feeling when you know that their job is going to be eliminated? Talk to me about that, because that makes me able to be more effective in my communication style, in my messaging, and how you talk to people, and just walking down the hall and talking to the head of finance going, hey, how's it going? Do you have any questions? Where can I help? And that is the biggest thing that I have been challenged with. I've done 3 or 4 deals since the pandemic started, and that has been my number one challenge, is trying to figure out how to work through that. Because I think we underestimated the impact that as execution people and integration people that has been such a value to us over the years. Huge.
That's great. Yeah, the whole rapport thing. And also just the trust. Because as you say that's really how we can work on trying to get things done a little faster. And that's one too that I've often done on deals too, is just sitting down and, getting to know each other, not even talking about the deal, just doing a little bit of getting to know who they are, what kind of person are they, what are they thinking about. Then you start more into the deal, but you kind of create that base of a trust. And friendship in some ways, where it can then build into, all right, when I need to get something across the finish line, there's somebody on my side to kind of do it quickly.
And I'm going to sit there with you. And, several years ago, had to do a layoff, and I knew it was going to be hard. I knew it was going to be really painful. And I would sit with the executive team while we would write the communication, and half of them would be crying. And you don't get that kind of interaction with the team when you're on Zoom. It's just different.
Yeah.
And it makes you a better trusted partner as well, because then they learn to trust you and say, okay, she's working, we're going to get through this together. And it just, as you said, rapport, which makes a huge difference.
Right. Yeah, I agree with everything there, but it also had a flip side, right? Because it was a cheap money era and it was the pandemic. So people didn't take a lot of synergy. They did not rationalize technology. They did not do synergies.
Yeah.
If you wanted to reduce X people, you reduced a fraction of the X, and now it's payback time, right? So you went from one end of the spectrum to the other end of the spectrum. And that's what is causing all the mistrust with the companies. If you had been very transparent and open that, yep, we're in the pandemic, we're not able to take the synergy now, but at some point in time, we will operate like a normal business and we'll take those decisions then. Nobody communicated that. It was like, wow, cheap money, the rocket ship is flying and it'll fly forever. When the fuel ran out, you got to make those hard decisions. But that's the other thing in M&A, right? This work never goes away.
Never.
You come back to, you can call it restructuring, transformation, whatever. So take the tough decisions up front, get it done, and execute a business plan.
Yeah.
As you say, okay.
I was gonna say, there's something to be said for transparency. You've just been bought. I don't know how many times people have said, okay, I've just been acquired. Am I still gonna have a job in 2 weeks? And that it's being as transparent as you can. And if there's no communication, employees will fill that communication void with something. And that's then fighting an uphill battle.
It's also even just being able to say, hey, we don't know right now. We'll let you know, and it's from our own time. So it's not even needing to have a decision. It's just at least communicating that there's an awareness. We're going to come back to you. It's makes such a huge difference. And actually, Nitin, as you were saying too, how integration never ends. I do sometimes laugh because people will try to put that line in the sand, and we've all done the 100-day plans or the 90-day plans or whatever plan you want. But at the end, it really is just a really long game. Yep. And you could be back, 2 years later with a company that had made acquisitions to find out they never did X, Y, and Z. And the project they now have going on is essentially an integration just 2 years later.
Yeah, it's 2 years later, 5 years later, you have all these mushroom businesses here and there. And then, one day an activist gets on board and then you have to make the hard decision. So you try to not be the bad guy, but then you be the uber bad guy one day.
Right.
Exactly. I had a client a number of years ago and, oh, well, we're going to do this and we're going to do that. And I said, I understand the approach that you want to take. I'm going to tell you, if we don't do something different and we don't plan this a little bit differently, a year from now, we're going to be sitting here and you're going to ask me why I still have all this work left. And I'm going to tell you why. And we did. Yeah. A year later, we had the same conversation and they looked at me and they said, you told me I would be here. And I said, I know, I did. I told you, and it's not about me. It's just that, and when it drags on into your point, there's always something to do, and really being clear on your roadmap and your timing is so important. Or else you just left with a whole bunch of stuff.
And the delay of the decisions too.
Even in the pandemic, good executives, I know good executives who have said look, guys, we're off operating reality. I've never dealt with a pandemic. We will figure it out 2 years later.
Right.
But we won't be in this reality, right? At least that communication was clear.
Yep.
Yeah. And I have found too, just the delay, because I've, been in chatting with folks who have been acquired, and they may have been acquired 2 years ago, 5 years ago, whatever. And sometimes they still have this, oh, well, we're still not really part of that company. You never changed our email address, or we still have certain logos. And it's so fascinating because they're like, I mean, I know I'm part of parent company, but we're still, acquired company B. Yeah. So it has this effect, because then you talk to the executive level and it's like, oh, everything is great. Everything, we're all together. We are flowing. And then you go down to the offices and they're like, I mean, we kind of are.
It's funny. It's kind of that double-edged sword of big culture impact. But then you're looking at it going, well, wait a minute, we wanted to keep that brand. So we purposely made a decision to do this, but then it does have an impact on culture. And how do you try to make it all work together?
The brand is always a function of what is communicated to the acquired company, right?
Yeah.
I was twice part of the acquired company, twice. And we had the same thing. So when HP acquired Compaq, that's ancient history and there's many papers written on it. I was always the red team and the blue team. The red team used to sit here and the blue team used to sit there. And 5-6 years later, they would still say, I'm HP, but bear in mind, I came from the red side.
I remember years ago, I had a blue team and a green team. And I'm like, okay, that's it. We're not doing this anymore. It lasted about 9 months. And it was impacting the culture. It wasn't a culture impact, because you're like, well, I don't know, the blue team made that decision. I was not part of that. I was on the green team.
Not part of it.
Okay, well, wait a minute.
Always us versus them.
Exactly. I won't make you sing Kumbaya, but we're all part of the same company. So
those little micro things that really make a big impact.
Second time I got acquired was part of a consulting firm, and the acquired company viewed it as a very serious downgrade, right? So after some time, these discussions were getting on to me, and I'm like, wait a minute, guys, who do you think writes your paycheck, right?
It's all one place, guys.
Yeah.
We can't go back. I want to kind of touch on another thing that, we've talked a bit of the integration side, and going back to kind of the short trends, the macro stuff, there is that bit of the diligence where there's a little bit more heavy look at some of the technology, a different view too on some of the financials. So, what are you guys seeing as well, just kind of given the dynamics that are in the marketplace?
So I think there is a profound differential that has come between the IT and the technical diligence, and a lot of practitioners and people in the company still confuse them. So the IT is the stuff in the SG&A, and the tech it's a tech company like Skype or whatever it is, right? So the way you diligence them is very different. You go to the SG&A and you look at your org structure, your cost, your technical debt, your ERPs, your systems, rationalization, all that kind of stuff, right? And is there a huge fest there that can be cleaned up and leaned up? But when you're looking at the technology diligence, which is kind of every stack is different. You can't have a playbook because every technology is different, right? The value can be locked in the API, it can be the front end, it can be in the integration, it can be in the ecosystem. So the first thing is, where is the source and sustainability of the competitive advantage? Then is the stack, right? Is this stable? Is this scalable? Does it do what does it do? Where does this break down? Can it scale to like 1 million users, 10 million users? What's the security in it? What's the interoperability? What is the performance, right? Is it extensible? Is it open? And that starts to merge with commercial diligence when you're talking a digital product. And the skill set to do that is either nascent to none in the industry. So there's a lot of IT people try to retool this. Then when you have the second question conversation, like, well, not really, right? So the guys or gals who assess the ERP are not quite suitable for that. And when they come in here, they realize, oh, wow, this is a different ballgame. And again, what drives the valuation, right? Is this really a true multi-tenant SaaS, or you put a layer on top of it? Are you a big data and kind of now recall yourself AI and trying evaluation? So there is a big convergence between the commercial, operational, and technical, which is kind of forming a Venn diagram. And the biggest challenge is the talent to execute that.
Yep, and that's exactly where I've been focusing lately as I've been looking at some of the diligence. My question is coming a lot earlier of, what are you thinking from an integration perspective? Are we going to keep both tech stacks or not? What are we thinking? Are we going to build new products that the acquired company has on the acquiring company's platform? How are we going to do this? Because that for me makes a huge difference in the time and the cost of the integration, and then where we have some integration costs, some synergies. Are we going to dual run both engineering stacks? How are we going to do this? Then how are we going to look from a customer perspective? What are we going to do with that? And so the conversation about integration in what I don't even want to call it target operating model, but what the end result is really at the forefront. And I'm not saying, when do we know integration is complete? I'm saying, what are our first thoughts on what does the new company look like? Because that for me is really important.
Yeah, and some of these companies are small when you look at the headcount, but the operational complexity is in the technology. And people confuse that if it's like a 20% team, it's not a complex integration. It can be very complex just because of the stack.
Absolutely.
It's kind of going, I'm also thinking too, just in terms of when you're buying sort of this new technology, kind of bringing in, or innovation, doesn't even have to be technology. You're a company that's wanting to go into something that's a little bit more innovative as well. I feel now too, there is that other lens of diligence that needs to be taken into account. More of a, how do I really look at what we're buying and what does that look like for the future? Because I think sometimes you've got some people who are excited about an idea, but they may not have thought through, how does that really fit in? Whether it is, the business itself, how do we kind of bring it in so that it can be successful, or it could even be the culture itself. And then I'm also thinking innovation too, as I have a friend who sits in an innovation office. And one of her biggest things that she's been trying to push is being part of the diligence too. So that is one where, oftentimes, and she's not the only one, that you want to do something innovative, you've got individuals who are sitting more in the corp dev role, who are trying to identify really great opportunity, but they haven't brought in the team that's really able to assess, does this make sense? How will this look? Can we even take it on? So that's also another interesting aspect that I think that kind of pops up often.
It's a very interesting aspect, and I have seen, if not 100%, close to 100% failure rate on that, right?
Yes.
Three specific reasons for it. One is that whenever the old economy is saying innovation, what they really mean is that catch up, right? Because somebody else has already innovated that technology. So you can't uninvent it, you're trying to acquire it. So it's catch up. The second part is all those antibodies jump out, which are cultural antibodies, right? It's got its own patterns of change resistance, and so the speed to execute and all that is kind of very different. And the third issue is really that who has the skill set, the vision, and the ability to execute it at scale, right?
Mm-hmm.
And I think number 3 is probably the highest weightage where it fails. And number 1, which is playing catch up in the name of innovation, is 2 things that it usually fails. Now, leaving the target alone has also been tried. It has not really worked, right? But if you go back and see, do you really need to do M&A to do that, to get innovative? Because if you leave these companies, right, if you think about it, CRM was nothing new, right? CBIL existed. Salesforce kind of got at scale. Somebody got at scale. Let them scale and let the baby acquire when the baby becomes an adult, they'll acquire the old guy. That's probably the better way the law of business is playing out, to be honest. I would love to be proven wrong one day, but I haven't seen that work yet.
So we're going to remember this conversation so when it happened. It's definitely, I mean, it's interesting because even when I speak with my friend too, she had mentioned, they did buy something that they call, 18 thought was innovative. And she's like, it just did not fit with what the true innovation direction they wanted to go. But was it innovative for their company? Sure.
Yeah.
And to your point, Nitin, did it fail? Yes. They just didn't quite know what to do with it.
Yeah.
Good news is people continue to want to do it. They throw a lot of money at it. They also know where it is going to fail, why it's going to fail, and they never learn the lesson. But hopefully in this decade, they will learn the lesson and get it right. Even when you remember, Sarah, your days in the 90s, everybody say every M&A is going to fail, right? But now it's become a little bit more of a science. Things have started succeeding. So this will go down the same path, and innovation will one day be the right catalyst to make an acquisition and will succeed if you're not yet there.
Exactly. That's and I think, Vicky, back to your point, it was one of the things I always ask is why are you buying this company? Bottom line, tell me why, because that will help me figure out how to get you from deal close through to integration and what that looks like. Because if I don't know why you're doing this, it makes it a lot harder.
It's just a very basic question, just why.
Always ask why.
No, definitely. Let's see. I had a thought and I forgot, guys.
End of the day, long weekend.
There was something that was going to go off of one of the things you guys talked about, and completely slipped my mind.
Let's go back to the beginning. One of the earlier conversations, Nitin, as you were kicking it off, we were talking about the price of some of these companies that are getting acquired now. We're just seeing the bottom fall out of some of these prices. You've got companies who were like, oh, I can sell for $4 billion 3 years ago, and they're now saying, hey, I'll take $1 billion or something like that. Where are you seeing some of the changes maybe in how these companies are being treated? Are they like, yep, nope, we're done? Where are you kind of seeing that shift a little bit? Companies saying, okay, wait a minute, yeah, we're still interested, or we're no longer interested, or as they're looking at targets, how are they evaluating them differently?
So the first thing is that stock was an important currency to acquire, right? So people have had their stock hammered. Now, if you think about it, Google for the first time in the history is trading below 20x of revenue. How can you justify a startup getting 50, 60, 100x, right? So the acquirer's currency itself has kind of gone down. So stock purchases, they got to shed a lot more. The other thing is that many of these guys were looking at the comparator trends, the comparator side of the valuation, not the DCF side of the valuation, and kind of coming up with all kinds of, oh, Vicky's company sold for that much, Sarah's company sold for that much. So I have two of these more shiny objects, so I should sell for more, right? So that's gone. So that's the second part. And then now people are also taking, hey, look, you guys raised a hell of a lot of money. What, you burnt through 200 million in the last year? Where's the return on that? Where's the return? So what did you burn this on? So suddenly there's a sort of shift on, okay, where's the net cash flow? Where's the revenue? So that is now kind of getting under a lot more scrutiny. On your, wait, your path to profitability is what, 12 years? No, can't be.
Nope, that's not going to work anymore. Yeah, and I don't want to say that, not even similar to the tech bubble, but a little bit of that kind of bubble of, well, wait a minute, valuations were so high. Now everything is starting to shift. People are going, okay, time out here. Wait a minute.
A good analogy is to the housing market, right? Because there was all the free money and your house kind of pumped 2x for no good reason. Now that money is gone and it's like downward kind of spiral there in many of the markets. So it's a bit challenging. You can't go and say that, oh, that one's house sold for that much and that one's house sold for that much, hence my house is more valuable, right? If you open your house, there's a lot of work required inside. So that phenomenon has now set in, and I think with the interest rates and this ability to pay with stock being diminished, people are just more careful.
One other area to kind of, I'm going to go back into the integration piece too. And as we think about all these various changes and how we've been doing integrations for quite a while, we've seen how it's always been done the same way. And actually, Sarah, as you were just saying the word, target operating model, but we don't need to call that. I do find too that there is a shift of how do we really relook at integration? Because as we keep saying or hearing as well, that oftentimes people keep making the same mistakes over and over again. But the one constant too is the integration approach has often just stayed the same. And I know in both of your worlds too, you've done some changes. You kind of re-looked at how to approach it or what are the values. Can you share some of those?
Okay.
Yeah, I was gonna say, I think the biggest thing for me, what has been the bigger shift has been in the tech space, as we're looking at the different tech companies. The integration approach isn't necessarily will migrate from one system to the other and deprecate the platform that you were on or the company that we buy. The whole thinking of there's so much technology, not to the whole world of like email and things like that. I'm thinking like engineering platforms, tech stacks and things like that. The integration approach has to be a little bit different. It doesn't mean just a data migration. It is how are we then going to blend the two companies? And that is what I'm seeing a little bit more and more and more is how do we realize the benefit of both companies and what they bring to the table. I grew up in the banking world. So for me, it was, hey, we're getting everybody to the same system and things like that. That for me, you had to do that from a regulatory perspective in a lot of ways. But from my experience, having moved into the different industries and a lot more tech heavy companies, there's more creativity about how we're going to operate as a company moving forward. And that for me has personally been one of the shifts that I've gone through in my career on the integration side.
I've largely stayed in tech, media, and telecom, but again, it's the same thing, right? We've also shifted from the era of consolidation mergers when you bang the two companies together, take the back office and gone. I mean, if you look at this sectors, right, these sectors, bulk of the deals are done for talent, product differentiation, or for revenue. So you can't have the functional approach to it. And as I often mention, right, there are two types of integration. One is the functional side where you can sort of get the efficiencies and kind of move costs out, finite functions, same levers, headcount assets, rationalization of processes and all that. Then there's the structural integration. You're actually being hit by a competitor which is altering the structure of the industry, right? Like Netflix kind of as a tech company changed media and Uber tech company being changed taxi. So there's a structural shift there. You can't think functionally there, right? Because everything is hinging around that business model, then that kind of goes into your economic logic and then how your operating model should come together. And you got to get the whole machinery between sales, marketing, product, pricing, customer experience, all that firing together. So those become your primary drivers. So the way you configure your IMO is not by function, but by value driver. And then each value driver has a lead and a set of core criteria to hit to produce shareholder value, not the synergy. Because taking out 4, 5, 6, 10 million doesn't do much for a company that is commanding ARR multiple, not multiples of EBITDA. So that's where I separate synergy and shareholder value. The more you accelerate EBITDA on a SaaS company, that's where the multiple of the revenue and valuation comes from. Removing 10, 12 million is like cost synergy, right? Okay, fine, it's good hygiene to do. Work is not going to go away, but that's not what Wall Street is rewarding. So your metric drives your behavior. That's changed. Diligence, a lot of heavy focus on tech, engineering stacks, all that stuff. Technical debt is a big thing, right? You don't take shortcuts and kind of just hack your technology in because it's going to fall apart. And then you got to pay $1 billion like Southwest Airlines paid for the outage. So if you fix those on sound engineering principles, you pay $10 and fix it and not pay $1 billion down the lane, right? The law of M&A is that the work never goes away.
Yeah. Never does. And actually, I will say, even just kind of what I've been seeing with that whole value driver, especially with the serial acquirers, I'm seeing them wake up and really kind of shift towards that. But what I have found interesting is some of the companies that haven't really done acquisitions and it's very new for them, it's been a little bit harder for them to kind of get onto the value driver. It's almost a step process in some ways too.
It is a step process. It is a step process. And it is a maturity model. It is a maturity.
Yes. Yeah, because it's you almost have to figure out how to do integration in the basic.
Yeah.
And then you kind of take it to that next level.
Yeah, these elements never change, and it's almost like sending somebody to middle school skipping elementary, right? It's not going to work that way. There's some elements of the process and structure that are there that need to be in place. Your day one checklists and stuff that keeps you out of jail and keep compliance and payroll and all that. But that stuff doesn't create value, right? That's like a sort of a given nowadays. But if companies don't even do that, then you have bigger problems to deal with. So to me, all that, the back office, the synergy, the discipline of program management, integration management, that is a given, right? Without that, you can't even graduate to the next level. But the value creation is coming from that next step 2 level. The first one is really the infrastructure and process. You can turn the cranks, but the automotive doesn't run in front. That's the step 2.
Yep. No, certainly.
And I think that's one reason why we enjoy doing what we do is, we've all been doing this 2 decades plus, and it's, the standard, the project management, the basics, and what you just said, they're always there. They're always going to be part of it in some form or fashion, but it's the creativity around how are we going to do this, the different technology, that for me is what keeps me coming back to deal after deal, because you get that creative side as well.
Yeah, and I think what has changed, to your point, is that the program management, the rigor, structure, discipline, all that stuff, right? When we go back 2 decades, it's like, oh, I learned that, so I'm an integration person. Today, that's your right to exist, right? Your creativity is what creates your value.
Mm-hmm.
Exactly. I can't tell you how many times I try to encourage my folks, a playbook is fine, a checklist is fine. Where your value is going to come is how you talk to the client and how you figure out how to execute the integration in the right way for this particular deal. I don't want you to manage through a checklist because it will fail every time.
And even if you look at what is a serial acquirer today, right? If you really think about it, there is no serial acquirer, because serial acquirers will do the same type of thing over and over again, and you kind of attain scale, right? Today you have the consolidation, adjacency, carve out integrations, you have acqui-hires, you have these new business models, you have digital deals, and you're not doing
different.
Yeah, and you're not doing every one of these deals in a given year like 10 times, right? So you may be a serial acquirer for a certain type of a deal in a certain specific time frame. But it's not like you go and buy your competitor and you kind of bulk up like the 90s. It's not that world anymore.
Yeah, I agree. And I know, Vicky, you and I have talked about this for a long time as we talk about playbooks. How do we get an effective playbook that we can use? And I'm like, I always say, well, wait a minute, how about this? And that's
it's like you can have,
So
yeah,
the
you can have your
playbook is
base.
Yeah, the playbook is that there's no ideal playbook, right? But if you get
Right.
60% of efficiency from it, I think you're doing great. But that other
Absolutely.
20% has to be deal specific, creativity specific, value specific, and thinking outside the box.
Absolutely, all day long.
And I think that's when people coming into M&A, especially the integration, they're always looking for the answer. They're looking for that M&A Bible, like this is everything I have to do, and it doesn't exist. It's we can give you your checklist is these are the big areas to kind of think about. Now you've got to understand what you bought. How does your company work? And it really is, you got to keep adjusting it and making, making changes.
Yeah, that's one category of people. I've encountered the others, right? They try to solve these non-existent problems and not focusing on the existing problems, right?
That's true too. They like to create more
It's like
problems.
go straight for the moonshot, but the house is on fire.
I understand everybody likes to feel valued. We all do. We all want to add value, but making sure that you're focused on the right things is really important. Yeah. I don't need a 1,000-line project plan. This is an acquisition of a company of 30.
Yeah.
Let's be straight here. So.
Yeah, and then back to kind of what you mentioned, Sarah, the execution. It's all about, hey, it's only successful if you can get it executed. You can talk pie in the sky, there's everything that needs to be done, but if you can't get the people to do it or figure out how to do it yourself, it's just 1,000-line item.
That's all it is. And having people come in probably the past 15 years, I've worked with a lot of different consulting firms and a lot of different people on different teams, and there's always some good and some bad, and hearing the different perspectives. And I don't know how many times I said, I can't just buy a playbook from you. You don't understand our business and you don't understand the dynamic and what we really need to do. So let's get creative here on how we're actually gonna make this work for where we're at. And that's really important. I know in my space, especially in the consulting space, it's super important. I'm just going to meet you where you're at. I don't care what you have or you don't have. We're just going to figure it out. And I'm not going to try to overcomplicate your world.
Yep.
Yeah, and that's also an interesting thing that consulting has gone through a change itself, right? You had a lot of generalists, and then there was a good reason there, right? Because if you were doing the back office skills, your IT, HR, finance, to some extent, real estate, not that much supply chain can cut across industry 70-80% of the time. But if you go to the front office, your products are so different, right? Manufacturing a widget, building software, the chemical formula of a drug are so different. And because they're different, your whole sales, marketing, distribution, pricing, everything changes. So you cannot really execute a good revenue plan without knowing the industry pretty well. So if you take a generalist, put them to run in the front office, this 1,000-plan checklist is what you will get, and it may or may not be effective, right?
Exactly. It scares me when companies say, well, I'm just going to go hire a consulting firm to come in and do this integration. And I'm like, you're going to have a lot of misses because your consulting company isn't going to know your company, and they're not going to know what potholes to step into. They need leaders at your company to help make things real for them, to tell you what's going to work and what won't work.
Can't just drop them in and let them go. You still have to work together. It's not just the automatic answer. It's no, you still have to collaborate and help them fill in the gaps so that it can be a successful integration.
Yeah. Exactly.
We have so many topics we can keep going further in just with this first session. Which on that note, this really is kind of, that first inaugural session of, hey, let's just talk about a few things. And kind of going back to, I think, Sarah, you and I spoke about this, is how do we just make it more free-flowing dialogue, get some ideas out there. And then as we kind of keep growing this, it certainly is the area of how do we now deep dive. Would love to continue to kind of even have the community in hearing what they're curious about and what more they want to hear as well.
Yeah, I love that. Yeah. And I think as we talk, with the divestitures starting to really bubble up here, do we talk about that and say, okay, what are we seeing and how do you best approach it? And what are some of the pitfalls and best practices? I've done way more integrations than divestitures. I've had a fair share, but I still am learning too. And I'm sure Nitin has some sage advice if you would want to come back in the future and do another guest.
Yeah, so I think divestitures is a complex topic and it's going to take more than 3 people on that because it's, even if you have done like 50 of them, they're not the same. Integrations have the similar patterns, even if the deals are different. Divestitures is not the same.
All right, we'll get some more folks. I'd love to do that sometime soon, so we can hit that as a relevant topic.
Perfect. Well, thank you, Nitin, for joining us, being the
Yeah,
very
thank you.
first
Really
inaugural.
enjoyed talking with both of you. It's great.
Pleasure.
And certainly thank you for all who have joined as well. And we look forward to having you on other sessions and look forward to your feedback as well. Thanks so much.